See me, hear me?
There we go. Yep,
Okay,
I
awesome.
gotcha.
Yeah, thank you, man.
All right. Hey, sorry everybody. I know Zoom, even after all this time, still gets the best of us sometimes. So appreciate your patience. Apologize for the delay, but we've got Tim on here now. So Tim, I know one that you guys have had a number of webinars going over this topic. So I'm not sure how many on the call today have seen those or are invested. So we've got a number of different people just joining from either invested in the properties or not, and maybe not haven't viewed the webinars that you've hosted. So um, I know up until a certain point in time, we sent you the comments and questions that were in the forum. So if you have those,
I
I will.
unfortunately I don't have them at my fingertips. Do you
Nope,
have them
that's
there?
okay. I've got access to them here
I'm
too.
sure
So
you do.
we will. We'll start with a couple of those. I'll just read them to you.
Okay,
We'll open up to Q&A once we get there, and we'll go from there. So sound good?
sounds great.
All right, all right. Um, First one was just the one that started the forum comments. So, anyone else have any thoughts about the additional funding? My concern is what happens beyond the 36 months. It doesn't appear to be a fix, seems to be a delay.
Really, I mean that's all we're immediate is the 36 months. I think we can we all know that you know the economic environment that we're currently living in is unique. Um, there's five assets that we're requiring additional funding for. So I'm not sure if everybody does know that there is five of our 58 assets. Five after the deep dive require some additional funding. Majority of them are newer assets. Um, why we're going out for an additional funding is from a strictly cash flow perspective. Uh, the the debt on all five assets has basically hit the rate cap, way before anything that we would have modeled or expected. Typically we'll see that year 4, year 5 in our model. Um, we model everything off the forward curve, anyways. Um, yeah, what happens in 36 months? Our lookout right now is we see some stabilization and normalization uh, in interest rates. Maybe not 2023, but definitely 2024. Maybe the end of 2023 and into 2024. Um, you know, we are seeing institutional investors starting to fly again, which is huge in our world, especially and I'm talking about specifically to the multifamily space. Um, right, they've been sitting on their hands for a long period of time. So what we need is activity. What I'm trying to get at is, we feel in 36 months, this additional funding will help us get over the hurdle for another 36 months. We feel that we will be in a better spot 18 months to 24 months, and that extra, call it 18 months to 12 months, taking us to the 36-month. From a cash flow perspective, the world will be, or the economy will be back to somewhat of normalcy.
All right. Thank you for that. I see there's some questions coming in at the chat. So we're going to start with what had come into the forum, and then we'll jump to chat too. Also, if you want to ask a question, if you want to hop on with and ask the question rather than type it in, just raise your hand and we'll kind of go in the best order we can. So, um, so Tim, can you talk about were there signals in previous reports on each of these impacted properties, or has this kind of snuck up on you pretty quickly and even within the last quarterly reports? And then did so I'll let you touch on that first because the second point is a little bit different. So were there any indications in quarterly reports prior to the announcement?
Yeah, I mean, we've been hinting to it a little bit in the last couple of quarterly reports, and of course in Jan's presentation at the year-end event. Um, you know, the last quarterly reports, we were kind of still more focused on collections. which again is cash flow as well too. Cash flow restraints, constraints have been there. But no, this didn't sneak up on us. What snuck up on us was the sharp increase in rates. And what we were doing as an organization strategically was trying to find a solution. And we've been working on this for quite some time. And what we've come up with, what we feel is the best solution. From a comms perspective, could have we been a little more, I guess, forthwith with the understanding that there was going to be a handful of properties, probably. That's probably feedback we'll take away. One thing that we didn't want to do in the quarterly reports is make it seem like everything's wonderful and flowery, because it just we try to give it a more of a realistic view, and we tried our best. But again, we're learning as we go through this as well. This is the first kind of major hurdle that us as an organization, Westmore Capital as an organization, has gone through. So again, it's a learning for all of us.
Okay. And I know this kind of tags onto the previous question, but what other previous tactics were discussed at an operations level for, pausing distributions, reducing expenses, pausing management fees, deferring CapEx? Can you kind of talk through the stair step of decision making that you guys went through?
Very similar to COVID. I mean, cash is king in these type of situations. So it's a matter of reducing your expenses, hoarding cash. From a fee perspective, we do charge an AM and a PM fee. They're flow throughs. It's not a moneymaker for Western Wealth Capital. And at these type of moments, these are the moments that you want to reduce your hands on deck. So your people, your operational people. You don't want to reduce the people actually on the properties, because that's we want more people on the properties right now. What we did do from an organizational point of view and an expense point of view is we got smarter. We centralized a lot of our operational stuff. We again moved to tech. So from an expense side of the ledger, we've done just what everything we think we've been able to do to reduce expenses. Again, we're hoarding cash. From a collections perspective, we still door knock. The technology we implemented, it's proving to work. A lot of our outstanding collections on a lot of these assets are the lowest we've ever seen in that. So the revenue is coming in. What we're also seeing is our turn cost is a lot higher, and that's just due to many different factors, such as the cost of materials, cost of labor. The units, when we are getting people out, they're beaten up, and the cost to get a good paying resident in there is costing us a lot more. So again, our turn cost was typically just turn to turn classic probably was about $1,700. That's increased and probably more than doubled. So that hits the expense side of the ledger as well too. But what I can say strategically from an operational perspective, it is at executive level all throughout the organization. Our focus is 100% on the operation of these assets and making sure that there is definitely light at the end of the tunnel, and it's a positive light.
Great, thank you. Again, too, if you're typing questions in the Q&A, we've got a couple that we're starting with first from the forum. So if you don't think we're getting to those questions, we will. So this one is a multi-part question, and I'll kind of read it to you, and we'll step through it. So how much capital are the GPs putting in, and what happens if they do not get the investment that you're seeking from current investors?
So I'll answer that first. I mean, the hope is it is a multi-step kind of process. The first large hurdle right now is getting quorum at the vote. So what we need on the U.S. side is we need 50% of the unit holders, uh, which represents quorum. So we, as a team, will be working very hard to make sure that people who cannot attend the vote do nominate a proxy. Again, you can do myself, Eric, or Dave. And if you don't have that link, I can more than happy to share you that link after. But we need quorum, which is very important. And once we have quorum, then we have the ability to vote to issue this new C series. The C series basically has a 10% pref. We're offering this pref to all of our A series unit holders first. So this is kind of the process that we're working through. Now, if we don't get the take up on the C series, meaning let's say we only hit 50% required on a certain or a particular asset or property, then what are our options? Our options are we go third party, and we know if we take a 10% pref to third party, we may not be able to get that uptake, especially at the amount of dollars that we're raising. We're not raising large dollars on each property. I believe the largest is 3 million. So if we got yes to 1.5 and we're taking 1.5 to the institutional market, it wouldn't get filled. We do have a number of investors that put their hands up, say, hey, yeah, we will over contribute. So that's great. That'll pick up some of that. But in a worst case scenario, we basically have two options. Option A is take it to a third party at a better return. And that's where that D series comes in. The institutions for that dollar amount would want a higher rate of return. So that's option one. And option two is to sell the asset, which nobody wants. We don't want that. I know the LP investors want that. So we really don't want that as an option. Now, as it pertains to the GP, I'm calling it family and friends. Yes, the GP is participating in all the deals. Myself, I'm in all the deals. There's family, friends that there are in the deals. We're all putting our additional funding in. What else is the GP doing? We will take a look after to see. Right now, we have a little over $7 million invested through loans on a number of assets. Some of those loans will be repaid with this additional funding. Some of that money is going back under the C series and buying back. Some will probably have to go back as additional loans as well. I know initially we offered a 10% or 5% give back to our LP investors as if you do contribute. As you can imagine, I've been on the phone for the last couple of days trying to gather proxies and talking to a lot of investors, and I've gotten a lot of fantastic feedback. And I've taken that feedback, I've presented it to the GPs and to the executive committee, and we listen. And more likely, you will see an email coming out in the really near future, outlining more what the GP is going to do for our A unit holders that do participate in the C series.
Yep. Thank you. So a really big point in there is if you are an investor in any one of these deals, make sure your vote is represented.
Yes, please.
So
yes, please.
Just like regular voting, make sure your vote is heard and make sure you help get the quorum, no matter how you vote.
Thanks, Ryan.
Next is if the debt service has increased, and this might be particular to Broadway, but if the debt service has increased $55,000 a month, that's $2 million more than projected. We're seeking $1.2 million, and if interest rates remain the same, do we have enough?
Well, from a math perspective, at the end of 36 months, we won't. I believe Broadway, we do go cash flow neutral or positive. I don't have it at my fingertips. I apologize. That's why we don't need the full two. I believe it was 2.2. You know, in near the end of the 36-month period. But if rates stay where they are, and beyond the 36 months, I mean, again, we'll have to unfortunately cross that bridge at that time.
Okay. This next one is a little bit two parts, so I'll tag it together. If rents decrease, how does it impact the fund, and what is the new exit strategy?
So if rents decrease flat period for the next 3 years, or I guess
I think it just said if rents decrease. So
yeah,
assuming that we're not stable, we're going backwards from rent.
yeah. I mean, tough to have a crystal ball. Everything that we see and we're seeing on a daily basis that rents right now are anywhere from flat to a small increase. We're not seeing the 20 year over year. We are still seeing positive increases, and actually in all the markets we're seeing close to double-digit increases um, on a Q over Q basis. So, I mean, if rents do remain flat or decrease over 36 months, really your job is to have the right tenants in place and making sure that your occupancy isn't at 93%, that it's at 95, 96, 97% with good paying people.
Okay. The next question, and if some of these sound a little bit kind of in the same vein, feel free to answer if there's anything additional that you want to add to it. One was mainly around the GP situation, and you've kind of addressed that. What other tactics have the GPs talked about too, as far as what they're willing to contribute, or how they're participating in what none of us see as an ideal situation, but how are LP interests and GP interests aligned in kind of sharing where we're at right now?
So I mean, it's I understand the frustration, and maybe the perception of a lack of empathy, but it's definitely there. As a GP, I mean, we do receive fees up front. There's ongoing fees, but that's a flow through type of fee, AM, PM. We do get paid. The fees up front are to keep the lights on, pays people like myself. Um, but the GP does pay out of their pocket, uh, for the ongoing, basically operational Westmoreland capital, to keep the operations afloat. It keeps our accountants, it keeps our operations, corporate operations, lawyers, accountants, everybody, everybody involved, and it basically keeps us current. Um, that's things that really LP investors don't see. Yeah, we make a lot of money in the back end. We make a ton of money in the back end when things turn out right. We truly do, and that's the win. So for the assets, like these five that we're talking about today, there is a lot of out of pocket expenses that the GP is paying for it that the LPs just don't see. Now, again, Westmoreland Capital and the GPs do make a lot of money and have made a lot of money in deals where we've had a lot of success. And um, we feel that we continue to fund these assets and that are struggling with cash flows. We can't continue to fund them. It is from a business perspective. Um, we have been funding through interest-free loans, but for doing this for 36 months on 5 assets is just not a good business case. That's why we're asking for this additional funding. Now, at the end of the day, if these assets break even, if we get all the money back plus a small profit to our LP investors, that's fantastic. It will not be a profitable situation for the GPs whatsoever. In fact, for the GPs, it will probably be, from a pure math basis or accounting basis, it'll probably be a loss. So there again, I guess long and short is there's expenses, there are things that the LP investor does not see directly.
Okay. Last one from the forum, and then we'll move into the Q&A here. It seems the proposed solution is to ask LPs to vote to approve putting ourselves lower in the capital stack, or possibly to allow a new class of investors, third party, if we don't secure enough funding. Can you kind of address that question in general?
Well, you're correct. It's exactly what we're doing, and the reason why we did that is I mean, we didn't want to sell the property. B, we didn't want to do a direct cash call to our A unit holders. So we thought this would be the best solution to raise the capital required, or the additional funding would be is in waterfall perspective, right behind lenders, ahead of the A. However, what we're doing is we're offering this to all of our A unit holders first. Now, if everybody comes in their proportionate share, then really it's taking money from your left pocket, putting it in your right pocket. It's a wash. Where you'll see, you're not getting a pure equity dilution, but what you will see is a return dilution at the end of the day if you do not participate.
Okay. Dave, I know you had a question, so I'm going to see if I can add you to Dave. If you're there, did I hear you?
Yeah, can you hear me okay?
Here we go, Dave.
Hey, Tim.
Hey, Dave.
So yeah, that initial email when you guys asked about, hey, we got some properties that are hurting a little bit, we're going to need some extra funding, and I think, like others, myself, I was like, oh sure, I'll jump all on that. I'll help out however I can. And then we get the webinars and they about the additional funding, and it's just like it's a kind of a hit to the stomach. I mean, it's just like, wow, this is really serious. I guess I was kind of surprised. Well, maybe I asked this question first. Those numbers that this updated pro forma is based on, is that still with the 35-65 split and no 10% preferred return? Is that what those calculations are based on?
Correct. What we showed is a uber conservative type of approach. 65-35 is not the weighted average, adding your 10 in. Yes.
Okay.
Yeah.
Right.
To answer your question, correct. Yes.
So like the one that has to do like Embry, where it's a negative return after 5 years, again, hopefully these are all things that aren't as bad as were put on paper. But if you have that negative number, then would it be my understanding that there is no preferred return? There is no return on that?
Correct.
You just basically get your capital back.
It's correct. I mean, what we're saying on Embry, and I believe, correct me if I'm wrong, I don't have the numbers in front of me. It's 29 cents on the dollar right now. If we had to take that to market and sell it, meaning it's a 71-cent loss. If we do what we just say we're going to do, we have that cash injection. At the end of the day, I believe it's as you said, it's -11, so you're getting 89 cents back versus you 21.
Mm-hmm.
Or I'm sorry if I misstated that, but along the lines.
Yeah.
Embry is a newer asset as well too. So typically
Sure.
Stabilization, there's always a J curve,
Right.
and unfortunately, the 5 assets that we have are newer assets. Embry is our last property that we just purchased, so
Mm-hmm.
it is basically at the bottom of that J curve.
Right.
That is the one asset or the one property that the timing just really does. I hate to use the word, but it sucks. I don't want to dismiss that because I'm an investor as well too. But the timing is horrible. We're kind of at the bottom of that J curve. We're stabilizing it. Occupancy strong. Collections is really strong. We got great payers in there. I really see that asset in 36 months. The metrics on that asset, in my Tim McCleary's opinion, will be a lot better than what we presented.
Well, we all hope that. I guess there was reference in one of the webinars about perhaps one additional property. Are you able to release that name that might come under this same type of situation?
So we do have the 5 that require additional funding. We have right now, I can say, 12 other assets that are in one stage of being sold. And, of the 12, I'll say that there's 3 in there that are being sold just because when we've done our modeling that, there is some concerns around cash flow. Yeah. So I can't say the name of those 3 right now, but the hopes is we can exit, get some cash off the table, and we won't have to worry about this conversation.
Okay. Well, I know you guys, I would think in your line of business, you would want to avoid ever having to use a capital call, which we did something different than that. But also just even low returns.
We're going to have, Dave, and unfortunately, we're going to have some with low returns. And I mean, strategically, we made the decision. And I believe Janet said that we've been seeing it. We're going to start selling assets where we feel it makes sense to sell, to get some cash off the table. We have a cash at property, that we had a group just went hard yesterday. Escrow went hard, which is fantastic. It's an asset we've held for a while, I believe close to 4 years. And unfortunately, it's going to be our first single-digit annualized return, looking at the first in the math right now. But I know, when talking to the investors in that asset, they're going to be happy that we're exiting.
Mm-hmm. My last question is just about the amount of renovations, and all the pro formers kind of leave meat on the bone. They don't do 100% of the renovations. Is that anything that you guys discussed about doing less of them or even more of them for forced appreciation? I mean, I realize we just got, here's the offer. We didn't really get any choices about, hey, we could put a little bit more money in, we could renovate more property or units, and perhaps do forced appreciation that way. But I appreciate your comments. Thanks, Tim.
Yeah, thank you, Dave, and appreciate your support. So there's 2 things around that. One, before we came to our investors, we looked at an option of raising additional funds to basically, as you said, Dave, force value, do more value creation through renovations. However, what we don't want to do is take that additional funds and sit on it, because right now is not the time to be doing renovations, because for every dollar that you're spending on a renovation right now, you're not getting the return for it. So there is cash put aside for that. It's not a ton of cash for that additional value creation. We have stopped all renovations right now. We will put a washer dryer in if requested, but we have stopped the renovations because right now, from a math perspective, it's not accretive. So,
interesting.
Yeah, so we do have part of that additional funding. There is a little bit of money put aside for. I think it went under the work. I forget how we worded it, but there is some money there. But we were thinking about actually raising over and above some additional funds. So when we're ready to go, let's go. But again, we didn't want to sit on that cash. It just doesn't make sense. It really doesn't want to. It just doesn't make sense right now. What the hope is if the market does turn, and again, this is a hope. If the market does turn, we do see a little bit of normalization, that there could be a possibility on some of these properties of the 5 that we can go back and refinance and take some cash, and we use that, get better terms on debt, and take that cash and put it towards renovations. We're also looking at the possibility of Fannie and Freddie have come out with some great fixed term rates right now. We have some assets out there that have appreciated. We are looking at maybe doing a refinance, going fixed, because the market right now for rate caps,
Mhm.
which is basically just an option, is still very dynamic. You know, we have 3 assets where the brokers come back to us and we're putting an additional $121,000 to $303,000 a month in escrow just for the pending rate caps coming up. So if you can free that capital up by going with a fixed rate, it would really help the property. So I guess what I'm trying to say is we're looking at everything. We're looking at everything, and it's basically we see this as a form of, you know, we're in a battle, and it's all hands on deck right now.
All right. Thanks again.
Yeah, you're welcome. Thank you.
Thanks, Dave. And I saw another hand raised, but it looks like it's down now. So I'm trying to kind of keep a timestamp on hands raised versus questions coming in. So next one we have is I've invested in over 25 deals. I invested in Bel Air K Station, the only project where I got a capital call. I've spoken with other operators, and some of them are ready to put their own money in if needed. Where did it go wrong with Western Wealth that has done so many deals to not have anticipated this type of rate increase?
I mean, that's if I apologize to the individual who asked the question, but if you knew rates were going to increase this quick, then we'll hire you. I mean, I don't think anybody globally knew rates were going to increase this quick. Now, you can always second guess yourself when it pertains to selling, modeling. You know, we do everything on a best efforts basis. Yes, we do have a lot of data. We have a lot of data above and beyond, you know, a lot of others out there. You know, we would never just underwrite an asset knowing that it wasn't going to work. We would never do that. And you know, the link, I believe you said they're investing in the link, but I mean, the link is again, it's a phenomenal property. We're still getting great rent bumps. You know, I believe we're still 9% Q over Q year over year there. The NOI growing. It unfortunately, that asset was a little higher leverage. It was bridge debt and variable. And yeah, we went from, you know, paying call it a 4.5 interest rate to 6.8 instantly. And again, it's something we didn't foresee. Now, again, the hope is that from a cash perspective, this cash is going to help us, you know, for another 36 months, get us to a point where we either refinance it or sell it. And hopefully we can do that beforehand, or refinance it to better debt.
Okay. You answered this before, but if there's anything you want to add, are the sponsors investing any or all, or is this all a raise from the LPs?
No, it's from GPs, families, and friends. We're participating in all 5 of these assets.
Okay. Has Western Wealth decreased the AUM fee to help with the funds?
So we don't charge an AUM fee. A little bit different than a fund, where a fund or maybe the operators charge a 1 or 2% or 3% of what assets in their management. So the value of that asset, we don't charge that. We charge our asset management fee is based on gross monthly rents, which is a smaller number. So it's 3% of gross monthly rent. So it really doesn't work out to a very large number at all. And as I mentioned before, I really, you know, no, we are looking at reducing that right now. It's basically, as I said, it's a flow through. It pays people the salaries that are actually on those properties, manage those properties, getting the good tenants in, trying to get the non-payers out. And right now, you know, now's not the time to to reduce expenses as pertains to a head count.
Okay. Again, just adding on to the questions, if you've answered them before, are these for the only properties? I believe there's 5 in total.
Right.
Needing a capital call, or do we expect more capital calls? And again, capital call being kind of the vague language there, from other properties as well in the future. And I think you kind of answered that, but if you want to add anything to it.
Yeah, I mean, again, traditionally we our strategy was on a quarterly basis. We're looking at our portfolio. We continue to do that, but there is a number of assets. I'll say 8, the 5 that we've already done the additional funding on, and another 3 that are actually for sale that we are watching on a monthly basis. That doesn't answer will there be an additional funding on them. Right now the answer is no, but I'm not going to sit here and say no, flat no, and 3 months down the road we come with our hands out and you call me a liar.
All right. Next question, repositioning tenants is not a new process. Why should tenants be ripping up properties now as opposed to past deals?
Sorry, maybe I didn't hear that question correctly. Can you ask
So
it again?
I think the question was referring to how tenant turns or properties are being left more in disrepair. I think there was a comment either now or on a website before. So just now versus property condition with exiting tenants now versus in the past.
Yeah. Okay. So I mean, it's 2 parts to it. One is just the cost to turn that unit's higher, just because pure costs are higher. But you're correct. I mean, there's always turn on real estate. What's happened is, during COVID and that COVID hangover, we weren't able to get residents out that were non-payers. They know they were leaving. They were in there for 3, 4, 6 months, and some are still in there. Call it 7 months, not paying, and they're kicking up the unit pretty good. Traditionally, we had somebody out in 28 days. We're not. Again, people are in there now for up to 6 months, and of course, if you're leaving, you're not taking care of your unit. So they're a little bit more banked up right now than they previously were.
Okay. I believe you've answered this, but if there's anything you want to add, will GPs reduce any fees on these properties to help ease the burden?
Yeah, again, from an actual fee perspective, the only fees that we take is the asset management, property management fee. It's just a direct flow through, not a profit center for Western North Capital whatsoever. Right now, really, it just doesn't make sense from a fee perspective. From again, we'll talk about it again. From what is the GP doing over and above, what they do on a day in day out basis for these 5 assets. We are adding the other 5% to the back end. And if I was a betting man, and I do like to bet a little bit on craps, and football. I do feel that you'll probably see something in the next couple of days about some additional support.
Okay. Follow-up question on the class shares. So assume there are not any fees being charged or taken out of the Class C shares.
Correct. It's a straight 10 pref crude paid at disposition, and paid right behind it.
Okay. The presentation Mark saw for the Embry has a new pro forma that showed a 16% loss if sold in year 5. How conservative or realistic is that? And is there a better case than that?
Yeah, this is the Embry. I think we talked to it with Dave. Again, it is, the Embry is, as I said, it's hitting that bottom, that J curve. Timing isn't great, but we have to model it based on the information we have today and what we see possibility of 36 months down the road. So we're not going to sugarcoat it, make it look any better than we feel it should. we did the exact opposite. We wanted to make it look like, as Janet said in December, we want to make it look dark, and we made it look dark. Really, the hope is um, at the end of the day that those, when at the end of 36 months or before that those aren't the actual returns that we're going to be experiencing.
Okay. And you talked about this a little bit earlier, but can you talk about the application for long-term agency debt as opposed to as an option to water this or to weather the storm?
Yeah. So again, what we're seeing coming from Fannie and Freddie is they're throwing some fixed 5-year rates out there that are very reasonable. So what we're doing as an organization is we're simply just doing the math. We're doing the math on all of our properties to see if it really makes sense to refinance or switch out the debt to fixed. And again, really what it comes down to is math. Now, why did we use fixed before? Is because really our model is it's just a flipping model. We're not a long term. If we were a yield play, fixed debt makes sense. We're not a yield play. We're capital appreciation. We're plain simple. We're a flipper of real estate, and nobody really wants to buy your debt. And but right now, if it makes financial sense to the asset to put fixed in place, we'll do it.
And I think you bring up a good point. And one thing to keep in mind is Western Wealth Capital is an appreciation play, and the tool that you use is debt. And unfortunately, it worked against investors and against Western Wealth in many of these cases. As far as you guys' advantage is speed of the process, and unfortunately, the speed of the interest rates rising was totally unprecedented, and just not able to get ahead of that speed curve for implementing the business plan in general. So you make a good point about debt and how it's used specific to Western Wealth Capital. Peter, I think that Tim had answered the question too, and I know these came in probably a little while ago about the possibility of another capital raise after this one. So Peter, if there's anything else, just throw it in the chat, but I think that Tim has gotten that one. Have we hit a ceiling of these properties' interest rates? So maybe just a quick discussion on where we're at as far as it relates to the cap rates on, or the rate caps on each of these properties.
All 5 properties that require additional funding are in the money, meaning that we have hit the rate cap. And how it works, actually, how we pay is we actually pay current. So we pay at whatever the current floating rate is, and then the lender rebates us or gives us back the difference on a monthly basis. So it sounds like it's a win, but we're in the money on all 5 of these assets, which is a good thing. But we're at that rate cap on all
5. Okay. Next one is are 3 assets included in the 12-unit sale underwater break even or single digit returns? And I think you had kind of alluded to that and can't name them specifically, but I would anticipate that it's either in all of those cases, it's the optimal time to sell was the reason, whether it's the return that's enticing or enticing, or it is that the possibly injecting cash was the other option.
Yeah. So I mean, the 3 additional based on modeling would be a single digit return. It wouldn't be a loss. It would be break even to single digit return. But again, right now selling assets in this market is laborious. It's a little bit tougher right now. We have an asset for sale. I'll let you know, it's Park 610. It's we put the for sale sign, call for offers. I think it expires today or Friday, tomorrow. We've already got 128 offers. So yeah, I mean, you think about, wow, that's fantastic. And it is fantastic, but the work that goes into going through those offers is laborious, and it's even with Woodstream and Arches, which we closed in December, January. We were receiving bids at 50% of ask, and that just slows the whole process down. So it is a bit of a little more laborious task. It's taken a lot longer, but again, based on our modeling, that Park 610 is not one of the ones of the three. I'm sure I should clarify that. This is just one that we have for sale right now, and I'll call for offers. But that just shows how many people are bidding on these assets, and there is a lot of interest in the marketplace, but a lot of stuff is not quality offers.
Okay. Next one, and again, one that you've kind of touched on too, but you've mentioned that GPs are contributing. The question is how much, and I think you kind of alluded to a general loan amount that is in on this from the GPs. But if you want to add anything to that question.
So there's a different percentage on every deal, every single property we own and operate. Asteria, as an example, it's about 4% of 4% of the equity raised it basically falls under GP, and I say friends and family, and I'm not a GP, so my investment falls under the friends and family section. So it's about 4%. I believe it's about a $28 million raise. So call it just over $1 million.
Okay. Last question that came into the general chat is the Linkit Planet was bought last February. It's less than a year, and we're already getting the additional funding request. So was it an overly optimistic underwriting scenario, or if going in the rate was 4.5 and now it's 6.5, it's 2% higher, but at the time the forward guidance was that interest rates were going to increase. The only difference is how rapidly they increased. So is there no room for error in the underwriting models?
Yeah, I know, and I'm sorry I threw that number out, and I shouldn't just throw that number. I I apologize. I don't have those numbers, so please, I apologize if for throwing out 4.5 and 6.5. I believe it's greater than that, but I mean, Link was a higher leverage, and we do over our 5-year period that we model, we anywhere from 100 to 150 basis points. We gradually go over the 5-year period over and above whatever current rate is. What we've seen is that increase for Link happened, I believe, as you said, it was February. I believe it was about April, May, or May, June, when the rates really shot up, and so we were hitting our rate cap in month 4, whereas we probably modeled we were going to hit it in year 4. That's the major difference. And again, I don't think we could have foreseen rates dramatically increase that quick. If we would, we would have bought the property, or we would have got fixed.
Hey, Tim, and I had a couple other questions come in to me. I want to be respectful of your time. I know that you've got questions like this from investors all over
That's
the place
great.
too. So let me know when you need to drop to. Have there been any discussions about operational shifts going forward as you guys move forward as far as fee structure and how your fees are structured, how your splits are structured? Have there been any conversations about what changes either underwriting or operationally as you move forward into different times?
Well, from an operational perspective, I mean, we're always trying to be strategic and talk about where we can become a better operator. From an operational perspective, we're doing a pretty darn good job. We believe we are. We think we're very good operators. Again, there's not many assets in our portfolio where I can say from an operational perspective that asset is suffering because of the operations. None of these 5 assets that we're talking about today have operational issues. It's math. Now, strategically, are we sitting around the table talking about as a go forward, look forward, long-term strategy from a do we look at our model different? Do we look at our business plan differently? Do we look at our fees differently? Yes. Short answer is yes. You know, what the outcome of that is, I can't say, but what I can say is 100% yes. We're constantly discussing that. And we talk about it every Wednesday morning. The six of us sit around and we discuss it. So it's I think I answered.
Fair. Yes.
Fair enough.
Fair enough. Fair
Yeah.
enough. The question was, you know, modeling the pro forma for each of these deals, quite frankly, has been wrong in modeling out interest rates. How confident are you as a team that building this additional funding structure, you've modeled out conservatively where interest rates still might have a ways to go before they peak, and then how fast they also come down in modeling the additional funding necessary in these rounds?
So, I mean, when we modeled before we bought these 5 assets, actually when I say newer assets, there was probably 19 that we closed on that kind of fell into this bucket. 5 of them are the ones that we're talking about now. You know, the economic world, or just the world in general, was a different place. And, you know, we're modeling off of the information that we have right now. I hate using this term crystal ball. Nobody has a crystal ball. We can't forecast, you know, if there's going to be another war somewhere else. Sure, we can be a lot more conservative with our P&L, with how we model out debt. Again, we maybe look at fixed term debt. There's a lot of things that we can take a look at in the future. But with the models as presented for these 5 assets, you know, we did multiple deep dives. You know, not only just amongst the executive team, you know, we had not only the asset managers, property managers, we had, you know, people working on site. We drilled down to make sure that the data, the inputs that we're putting in were correct, and not only correct, but with about a 20 to 25% buffer from a conservative nature. So yeah, we're pretty comfortable with these models, and I know, you know, we've always used the term, you know, under promise and over deliver, and you know, we've had the ability to do that. You know, and albeit we were in a very good market, but again, that's still remote. Our goal is to under promise and over deliver. And we, you know, as an operator and as you know, as a trusted group that you invest your hard-earned money in as well too. So.
Okay. There's one that came in here, but I want to finish this next one. Can you, and I believe you guys explained it really well in the webinars specifically, but can you just talk about kind of the pros and cons of each investor opting in, and we won't say above and beyond, but opting into funding their pro rata share in each property versus not? Kind of what are the pros and cons as they make their decisions for, do I invest at my pro rata share or not?
Yeah, it really comes down to how we look at it is a bigger picture. You know, you mentioned, Brian, you know, voting's important. Why is my vote important? Well, if you don't, your neighbor doesn't, their neighbor doesn't, then guess what? You know, we're in a tough situation. So we need this additional funding. We do. And if you know, one person says, hey, I'm not going to do it just because I'm not going to do it, that's your choice. Now, we understand there's a lot of hardship situations. People just don't have the cash to do it. Totally understand. You know, that's where, you know, the hope is there's some, you know, additional investors out there that are willing to put more in. But by not just doing it, really is detrimental to the asset, because our options at the end aren't fantastic options. They just really aren't great options. And But, how I see it as, and I'm using Sinester Asteria as an example. I have 75,000 in. I think my cash calls another 8,500 or I care 9,000. I can't remember what the number is. I'm seeing it as I'm putting $9,000 in to buy another 36 months for Tim McCleary. That I really have the hope and the confidence in this group, and I feel that 36 months at the end of the day that it's basically going to be a better place. Knowing that if I don't do that, and if we can't raise all this additional equity, then I'm getting 50 cents on my dollar back.
Fair, and very good perspective from you as the LP. I mean, that's essentially where everybody on the call and everybody that watches is coming from. So I appreciate you giving us that perspective. And for reference, I'm an LP either through a group investment or individually in all of these assets. So these questions are important to everybody on the call, regardless of whether you're the biggest investor or the smallest investor in there. It's important. And so that alignment, you've got that insight into all the discussions, and at the end of the day, it affects you as an LP investor. So we appreciate that insight from you.
Yeah.
Next question. What's that?
2 more minutes. That's okay.
2 more minutes. You got it. We got 2 more. One is specific. Valletta, any similar effect in that property?
So Valletta is another asset, falls under the 19. Deep dive. From a cash perspective, we feel based on our deep dive, Valletta is good for. I think we worked up to at least if no economic growth from forcing NOI to 24 months. So not a problem, because we are getting great rent bumps there. We're getting great rent bumps. That's fine. So don't have to worry about that asset. Okay. So you can check that one off the box. That's not one of the 3.
All right, perfect.
We can slowly work backwards, I guess we want. But yeah, I know for everybody out there, Ryan, it is never a good time, and I know even myself. I, as you said, sit alongside everybody on the call. To open the pocketbook, to put more money in, and it's never a good time. But how I'm viewing it as is, I'm looking at it from 2 perspectives. I look at it from a straight math perspective. Math to me makes sense, and then also, I've already put a little bit aside with what I'm going to do in 2023 from an investment perspective. So that money's going into that bucket, and all it means is I'll have less at the end of the day if there's new opportunities come up.
Sure. Last one. This isn't really a question, just a kind of a comment. John, I appreciate you putting that in there. We can second guess the underwriting and what the Fed had predicted at the time. So you make a good point there. But having said that, you're going to invest your pro rata share, try to keep these afloat and weather the storm. And like Tim said, nobody wants to be in this situation. Us as investors, Western Wealth Capital, nobody wants to be in these types of situations. But I think personally, this is my opinion. I'm not giving advice, but I'm doing the same thing, investing in the pro rata share. I don't feel like it's throwing good money after bad, and keeping these properties afloat for the best possible outcome, even if it wasn't what we anticipated, is what Western Wealth Capital and me as a fellow LP investor hopes everybody does, just so that we can weather the storm and move on and move our capital too. So Tim, I want to respect your time. Thank you everybody for joining, hopping on the call. Tim, if there's anybody that missed the recording on any specific property, missed the vote, how can they make sure they can see the recording, make sure their vote's in there, make sure they express their interest if they missed the emails? Reach
out to myself. I mean, I know we've sent the recording out. I know everybody's getting multiple emails. I apologize. I really do. But yeah, the recordings were sent out. If you missed it, let me know. It's Tim McCleary at westernwealthcapital.com. If you haven't received anything about the vote, please again feel free to reach out to myself. You're going to hear from me no matter what, myself or John, probably more likely me. Broadway we've already gotten through, but the next couple deals as the vote comes as we get closer to the vote. So again, reach out Tim McCleary at westernworldcapital.com. My name is correctly spelt on the screen there. So, or go on the website, you can see my name there. But again, Ryan, and thanks to everybody on Left Field Investors. And again, I really appreciate you guys' support. It's awesome. Thank you.
Thanks, Tim. Appreciate your time.
Have a great day.
You too.